All right, David. So as we wrap up this series on dividend stocks, there's one last really critical warning we have to talk about. Investors see these high yields and they get drawn in, but that bright, shiny number isn't always what it seems.
Yeah. In fact, sometimes that high yield is actually a giant red flag. What looks like an amazing payday can be a sign that a company is in some serious trouble. Honestly, it's a classic mistake that can really burn investors if they don't know what they're looking for.
That's so true, Mark. And this problem actually has a name, one that every single dividend investor needs to know. It's called the yield trap. So what is a yield trap? Well, it's pretty much what it sounds like. It's when a company is dangling this incredible dividend in front of you. We're talking 10, 12%, sometimes more, but the business itself is actually struggling or, even falling apart. That huge yield is just a mask for some really fundamental problems.
Exactly. So the big question is, how do you spot this trap before you fall into it? Well, the single most important tool we have for this is a little metric called the payout ratio. It's a really simple calculation, but believe me, it tells you almost everything you need to know about a company's financial health.
Okay, let's just walk through a quick example so you can see exactly how this works. So imagine a company finishes up its year. We look at their books and we figure out their earnings per share. That's just the total profit divided by all the shares out there.
And let's keep the math simple. Let's say the company earned exactly $1 per share. That's it. That's the actual profit they generated. Now, you're an investor, and you see they've announced their dividend, so you're thinking, great, I'm going to get a piece of that dollar. But then you look closer, and you see that they're paying out a dividend of $1.10. Now, hold on a second. How is that even possible? They only made $1 per share, but they're paying out more than they earned.
And this is the million-dollar question every single investor has to ask themselves in this situation. If the profit doesn't cover the dividend, where is that extra 10 cents actually coming from?
And Mark, the answer is never good. That extra money has to come from somewhere, and it's usually one of two places. Either the company is taking on new debt to pay you, or they're draining their own savings, their cash reserves, to make the payment. Both of those are completely unsustainable.
You just can't pay out more money than you make forever. Sooner or later, the music stops. The company's forced to slash that dividend, and when they do, the stock price almost always crashes right down with it. So the very investors who are chasing that high yield get hammered.
Right, and that's the danger zone we want to help everyone avoid. So let's flip this around. Let's talk about the solution. There's actually a pretty simple rule of thumb that can help investors stay in what we call the safe zone. So here it is, the number one takeaway. You want to look for companies with a payout ratio that is under 60%. Seriously, if you only remember one thing from this whole discussion, make it this number. A ratio below 60% is a really strong sign of a healthy, sustainable dividend. And here's why that number is so powerful. It means the company is paying out a nice chunk of its profits to you, the shareholder. But, and this is so important, it's also keeping at least 40% of its earnings to put back into the business. That's the money that fuels research, expansion, and all the future growth that's going to let them keep paying you and hopefully paying you more down the road. And that, right there, is really the core of smart dividend investing. It's all about sustainability. A huge, flashy yield is totally worthless if the company behind it is about to fall off a cliff. The real strategy is finding great companies that can afford to pay you today and have a clear plan to pay you even more tomorrow. So really, let's just frame it as a choice. On one side, you've got a solid, reliable company paying a 3% yield, but it's growing that payment year after year. And on the other side, you've got this shaky company offering a 10% yield that could literally vanish overnight. For anyone thinking long-term, the choice is pretty obvious.
Just let that sink in for a second. A 3% yield that grows every single year is always going to be better than a 10% yield that disappears next month. It's that predictable, reliable growth that actually builds serious wealth over time.
So we'll leave you with this one final question to think about. Go and take a hard look at the stocks in your own portfolio. Check those payout ratios. Is your portfolio built on a foundation of sustainable income? Or could it be sitting in a yield trap without you even knowing it?